All right. Thanks for joining. We still got that Barry Habib playing in the background. Had to re-listen to that. That's always good. My friends over at MBS Highway, so that overlapped. I'm running around. I'm getting coffee, getting water, make sure I'm all set because today going to jump into all kinds of fun and interesting mortgage stuff. Forgive me. I think I lost my breath running around this office, but it's like that in mortgage right now. We can talk about rates. We can talk about what the Fed is doing. I already saw in the comments somebody mentioned rates pulling back a little bit today. We'll look at exactly how much they pulled back. Let's keep in mind that when we're on an upward trajectory, we're going like this, rates are still on an upward trajectory. There's no changing that. And based on everything the Fed has said, and I'll get into it in this live stream, don't expect any major pullback, right? If you have one day where you go from 5.3 to 5.15, don't expect that like there's any chance of going to 4.5 anytime soon, right? It's just in the cards that the Fed is going to use all the ammo that they have to fight inflation, and it's going to take a lot, right? It's going to take 75 basis point Fed fund rate hikes and the like to get inflation under control. So today we'll talk about rates. We'll talk about all kinds of fun stuff going on in mortgage, like Wells Fargo laying off folks, Rocket Mortgage laying off folks. We'll talk about some cool stats that I've seen that might give you some hope if you're a home buyer. Markets that have been absolutely insane, like San Francisco, California, where as recent as February, they had from active to in contract, the data from the MLS was showing that was only 7 days back in February, which is lightning fast, especially for a market it's expensive as San Francisco. We're only 2 months later. It's only April. And that number has gone up to 47 days. I thought that was pretty wild. I follow Brooks Landry on TikTok. He's the video realtor. Great, witty, funny dude is the reason I follow him. But he also happens to have some cool stats like that because he does a lot of business. I think he did 80 million in sales last year. So go check out Brooks on Instagram under Brooks Landry, I think, or on TikTok as the video realtor. I want to talk about that. I also want to talk about in a market like this one that is changing. We want to be careful to not say things like housing market crash and things like the market's just changing, right? One, big changes will not happen overnight. Two, it's going to be a slow and subtle change that not everybody picks up on at the same time. And what I mean by that, like the video I recorded that's going to come out tomorrow, if you've got a real estate agent, might be a great person, might even be a half decent agent. If they're closing 10 or 12 deals a year, know that that's only an average of one per month. Their last closing might be 30 days ago, 45 days ago. They don't necessarily have a real good finger on the pulse, and it's probably not fair because some do, even if they're closing 12 deals a year, on what is happening like today, right? A prime example is a real quick story about an agent who I spoke to who had just got a buyer referred to them, who had a bad experience with another agent where this agent was just writing ridiculously high offers for the sake of getting accepted in some times where it wasn't even justified, right? If something's been on the market for 22 days and it's listed at $799 and they have 0 offers, why in the world would you go 50,000 above list? You just don't have to, right? Unless the last 3 transactions you saw, it was necessary on all of them, and you think that that's just still how it is, right? Things have changed. You've got to make sure that like all day, every day, you're paying attention to which way the wind is blowing, right? Because it's market by market, and it's not every single market. It's not even every single house or type of house or block, but listing by listing, you have to make sure you've got a real good grasp on what is it going to take to get this house accepted? And then on the flip side, as a seller, you've got to be able to identify, okay, here's the trends, but also like, what is the current vibe, right? Are there a ton of buyers and this thing's going to get 12 offers I can list here? Or have things slow down enough to where I've got to price it pretty aggressively, because the 3 or 4 offers I do get, I want them to be strong and I want this to sell quick and not sit, because sitting causes staleness and kind of a reputation for a home may or may not be justified. So anyhow, here we are, live Q&A, ask away. I'm in the mood to answer any and all questions as always. I'd love to talk about anything you're seeing or hearing out in your markets, because I really do think that things are changing. Things are changing from a buyer demand perspective. And I know that, I feel like, as good as anybody, because I'm working with hundreds of pre-approved buyers. And I can tell you that as prices go up, as rates go up, as people start to, make those hard decisions, is it the right time for me to buy? There are some that are bowing out. That's just the truth. That's the nature of what happens when home prices and rates increase, right? Affordability starts to slide, and some folks are just going to choose, now is not the time for me, which is fine, right? Real estate shouldn't necessarily be a timing thing as far as like timing the market. You should time it based on your own affordability, stable footing when it comes to credit and income and all that other stuff, right? I could preach on that for a long time, but let's just jump into some questions. Let's jump into some conversations. Let's see where the wind takes us. Bruce Lee, thanks for joining. Good to have you here, man. I appreciate your loyalty to the channel, all your comments, even, the wild and crazy ones like this one. Damage has been done. Dirt cheap interest caused the spike in homeless. That's a pretty layered problem, where I don't know if we can just point to low interest rates for that. But anyhow, appreciate you being here nonetheless, brother. Really long name that I don't want to screw up, but thanks for being here. You bought a house last summer in this crazy market. If you're thinking about whether or not you should view it as half full or half empty, I would view it as full. You got a home that is worth more today, and you've got an interest rate that, no doubt, from last summer is a great one. So I'd be pretty proud of yourself and pretty excited about buying a home in summer of 21, right? Because summer of 22, it's no doubt harder and more expensive than it was last year. I had to pay a lot more for the house, but still got the cheaper interest rates. True, which over time, you're going to be grateful for. Rates did pull back today. You are correct. But I think your follow-up comment about they're not going straight up anymore and showing some volatility, true volatility, but while nothing goes straight up, I would argue upward trend is still the case. And no doubt, we're going to continue to see that. We already know that everything we've heard out of the Fed is that they are doing everything in their power to fight inflation. When they talked about the next Fed meeting is in May, next month, they're more than likely going to raise the Fed funds rate by 50 basis points. Some people think they might do 75 basis points. But in the meetings we have left in the year, I think that they're going to target getting this Fed funds rate over 3%, right? So they've got to basically raise it every single meeting they have. Oh, man. Whoo! Here's, I'll share this screen. Granted, scenario by scenario, but like I was saying earlier, a quick little bump down isn't really a sign that we're going to start seeing lower interest rates. Here's this. And you can see just from like last week, 5.25, 5.375, 5.27, 5.38. 545. Really like Thursday, Friday were bad days. And then that, betterment today down to 532 basically got us almost back to where we were last Wednesday. But still, like, this is a nationwide average of a 30-year fixed. I even think that this is a nationwide average with some points built in. Yeah, look, 0.4 points. So if the nationwide average on a 30 is 5.32 with 0.4 points, if you've got a scenario with a smaller down payment or you've got worse credit, you're even higher than this. Look at these year-over-year changes. 2.2% year-over-year. Good golly, Miss Molly. That is a big jump in interest rate, right? Prior year 3.12. Not the low, right? In August, we were down in the 2.6 range, but still like from last April to now, over 2% increase year over year. Wild stuff. Not going straight up. Solon Garugar, but for sure upward trajectory, right? And I don't think that we're going to see the next 1% increase as fast as we saw the last one, but no doubt we're headed up. I can say that with a lot of confidence. All right. Great question, Matt Bittner. Thanks for joining us. Appreciate you being here. Reminder to everybody, every single Monday at 3 p.m. Pacific Standard Time, I'm here answering live questions, talking about different subjects, but mostly related to mortgage and real estate. Next week, I've got a really special guest, a great guy that has a really cool mission. And I'll kind of save it for him next week. Know that we are going to put out some information on this over the next week on who's going to join, but I'm excited about it. He's got a really cool initiative, Black home ownership and whatnot. And that's going to be a special one. We'll still be live. We'll still be answering questions, but I'm going to give him a little bit of a platform just to talk about his initiative, his mission, and what he's got going on. So stay tuned for that. I don't think we have any information on that out yet. So stay tuned. Anyhow, to your question, Matt, what percentage of borrowers are on variable rate mortgages? I couldn't find an exact number. I know from what I'm seeing and the conversations I'm having, this number is going up, albeit it's going up very slow. If I were to guess, the numbers in the 3 to 4% range as far as residential mortgages go. And for comparison, back in 2005, the number was 35%. So if we were 35% in 2005, and even if we've seen an uptick, we're still for sure below 5% in 2022, like 1/7 of the volume of adjustable rate mortgages in the current environment. So it's 1 in 20 at the very high side of my rough estimates in my head, right? I'd guess 3% is going to be my guess. When was the last time you saw a house in your area sell for under $100,000? In Sacramento County, where I'm at, we're nowhere near that, right? We're like $500,000 as an average. You could go like in any market, anywhere in the US, far enough out to where you might find some homes or some condos that are 75,000, 80,000, 90,000. I could think of some areas in my head that are an hour away where you could probably find something under 100,000, but it's going to be a condo or it's going to be a small house. It's not going to be in great condition. It's not going to be in a great neighborhood, but as much as people think that everything in California is $1 million or more, it's not necessarily. Under $100,000 market still exists. It's just, and not the areas that are close to the action, I guess is what I'd say. All right. Whenever things break due to rate hikes, I would look for rates to come back down. Things aren't going to necessarily, I agree that rates are going to come down, but it's not going to be like that things are breaking due to rate hikes. Maybe partly so, right? Like all the rate hikes that we're going to see from the Fed to tame inflation are going to cause us to go into recession faster, right? Headed to recession anyway for a number of reasons. If this pushes us into recession faster, then the Fed will have all that ammo, right? If they move the Fed funds rate to 4%, they could do, 8 straight 0.25% pullbacks, and they could pull interest rates back down to stimulate the economy, to pull us out of a recession. So a lot of smart money is bet on just that once we enter recession, after we've done all these rate hikes, we're going to have some bullets in the chamber to pull rates back down, and we'll see that. Who knows how soon that is, right? 6 months, 9 months, 12 months. But whatever the case, it's a real good argument for not paying a bunch of upfront points right now. I was looking at a VA deal this morning, and the veteran could save $100 a month by paying a point. And it really didn't make a lot of sense given that it was a 65-month break even. Now, that's the thing about paying points, is it's really case by case. 25, 30-month break even might make sense for some folks, especially if you want to make the safe bet, where if things don't ever get better rate-wise, you're locked into a great rate. 50, 60-month break even and longer, it's not going to make a lot of sense. If all this stuff sounds foreign to you, just know that this is the reason you want to work with a loan officer who, 1, has your best interest in mind, 2, has an idea what they're talking about, 3, is, an investor, someone who thinks about finance in general, right? So they can advise you. It's really easy to advise as a mortgage advisor if you're investing, if you're doing things with money to where you can say, hey, listen, I've looked at your whole scenario, and based on your time horizon, how long you're going to be in this house, how much money you have, what your budget is, so on and so forth. If I was you, here is what I would do, right? Because then you can have somebody who's literally analyzed 1,000 deals, 2,000 deals, say, based on all that knowledge and based on all the information about your specific scenario, here's what I would do, right? And good news for anybody out there, if you're working with anybody in mortgage, tons of stuff has been passed. The rate you get, whether you're paying points or not paying points or buying it down or not, the loan officer's getting paid the same no matter what, getting paid based on loan amount, right? So their only goal should be to get you in the loan that makes the most sense, because the better job they do, the more likely you are to refer friends and family and whatnot. So anyhow, that's a quick spiel. And while we're at it, if you're looking to get pre-approved, if you want to talk to me and my team, we are more than happy to help. Go to greatmortgagebroker.com, fill out the form, let us know where you're at, how we can help, and we'll be in touch within 24 hours. This is a great question here from Casey. Are you seeing any layoffs? Oh, shoot, we went back. greatmortgagebroker.com. Are you seeing any layoffs in the loan industry? For sure. And here's something, Carrie, that I will say. It's not all like doom and gloom and something that you point at and you go, look at them. They're doing it bad. They're laying people off. The latest numbers I saw were 62 or 65% decrease in refinance activity. I called this months ago that the numbers they kept reporting, 40% decline, 50% decline. I said, trust me, it's coming. It's going to go to 80% decline in refinance because it just doesn't make sense. And sure, there's still some people selling some stuff that doesn't make sense. They're talking people into refinance that doesn't make sense. But if you look at the raw data, true benefit, and I mean, I talked to basically data analysts from BlackRock. So I know that the in the money, they call it, or the folks that have true benefit from refinance is all but vanished. Refinance demand off of a cliff, right? So even though we're going to have a great year with purchase, and purchase money transactions is going up, right? We're still not going to be at the levels in 2020 and 2021 where we scratched the surface of 4 trillion in loan origination, right? We're going to have great years, record years, 2.6 trillion in loan origination. But when you look at 2.6 compared to 3.9, it's a big decrease, right? Because all that refinance is gone. Obviously, operations folks have to go. Loan officers have to go. There's just not enough demand to keep all those folks around, especially if you're at a bank or if you're at a lender that isn't hyper efficient, right? Even the ones that are hyper efficient, I guess you have to let people go when you have a 50% decline in volume. And even those that are putting, a lot of emphasis on purchase and doing great in the purchase market are just going to see a humongous decline, 60, 70, 80% decline in refinance. So Wells Fargo announced something that was public. I know some folks that used to work for Rocket, and they have friends that still work at Rocket Mortgage. I just heard this today. 1,000 folks being laid off. Another 1,000 are being offered a buyout to leave. And so even Rocket, right? One of the biggest lenders in the US, laying folks off. There are a select few lenders who are, still growing through a really challenging market, right? And on a smaller level, little guy like me, $100 million last year in mortgage production, there's still room for me to grow. There's 2.6 trillion in loans being originated in 2022. So, there's definitely contraction. There's mergers and acquisitions going on. There's all kinds of stuff going on in the mortgage world, as you would expect. We're literally coming off the 2 biggest years of mortgage history where companies that weren't that good survived. Companies that weren't that efficient thrived. Companies that, could barely tie their shoes squeaked out some profit, right? In 2022 and 2023, it's going to be different. And so based on that, Matt, have you started laying off employees? We're hiring based on the stuff I just said. We're like, little guy like me, $100 million. I'm still growing, right? There's still plenty of market share for those who are out there working hard, serving clients and serving referral partners. All right. The $1 million question. We knew we'd get it, so we might as well tackle it. Do you think this is the top of the housing market? I'm going to say something that probably will have some people throw tomatoes on stage, right? Like, trust me, the YouTube comments aren't always nice, but it's okay. I got pretty thick skin. I've been through much worse in my lifetime than some YouTube comments to get me down. So keep them coming, haters. We got much more on the way. This is not the top of the housing market. And truth be told, I don't think we're anywhere near the top. I think that there's a lot of runway based on supply and demand. And here's something that I want to see if I probably can't draw it that good to show up on. Is that hard to see? That's pretty hard to see, right? Like if a market is cyclical, right? And it goes up and down, and you're like, I want to time it because I think that this is the top of the market. If, like the stock market, if you looked at the last 30 years of the stock market, if like the stock market, the real estate market, and I say if as in like it is, for anybody who's not paying attention, wake up and smell the decaf. If it's cyclical, but it trends upwards like this, you're going to tell me, I don't want to buy here, right? Let's say we're here. We're not near the top. We still got a lot of supply and demand. So say we go up another 15%, but then we come down in the future, which I don't know if I see that, but let's say we do. So you don't buy here, right? And you wait. Oh, no. You end up buying right here. And you're like, man, I timed it closer to the bottom. I did so good. We see how this graph works, where whatever this is, one's a y-axis, one's an x-axis. It's been a while. If you look at this, you didn't buy here because you were too close to the top. You bought over here, like really close to the bottom, or over here, right? But this was 400,000, and this was 550,000. Did you do better by waiting? Like, look, you bought so much closer to the bottom. Even if you bought here, that's 475,000 or whatever it is, right? Like, it might be cyclical up and down. Granted, I'm no friggin' Picasso, right? But if it trends up over time, you want time in the market, not timing the market, right? That's my 2 cents. Just my thoughts. Like it or love it. Art T. I pulled out of my refi due to the increase in rates. Numbers just didn't work anymore. Fair enough. A lot of people did that. A lot of people, were looking at refinance for one reason or another. It didn't make sense. Interesting take from David Green from Bigger Pockets. If you don't follow Bigger Pockets, great podcast on real estate investing and whatnot. He had an event near me last Tuesday. I went and saw Kyle Ranke and David Green speak, and he was talking about 2 cash out refinances he did on properties he owns in California. He owns some other stuff out of state. He also owns some California real estate, and he literally went from a 3.5 to a 5.5 on 2 different properties, full 2% up in rate. And his justification was the money that he was going to take from those deals, 500,000 or 600,000, and place them in other deals that were going to get 12, 15, 20% returns. And that 500, he took, let's call it 500. If he took 500 from a cash out refinance, was able to buy another 2 million in real estate, that over the next 30 years, because he's a hold kind of guy, like a lot of us, he's going to buy 2 million in real estate. It's going to appreciate over time. It's going to be worth 10 million. And so like the fact that he's paying an extra 2% on some of this money he's borrowed, he's able to leverage it and buy another 2 million with that 500 he pulled out. Folks like that are in growth mode are less concerned about the rate. And truth be told, it even kind of helped me put some of the stuff into perspective, because I'm advising a lot of folks on strict numbers, right? Where they come to me and I've got a 3.25%. I owe 425. I've got some credit card debt. I might go invest in this, deal with my brother-in-law, whatever the case may be. And I see where there's a little bit of sticking point or reluctancy to go 3.25 to 5.25, something like that, right? So I think it's really specific. It shouldn't be just the rate you're looking at, although I know it's important. The refinance just to save money on a monthly basis is gone, right? And so now we're just analyzing cash out refinances on whether or not it makes sense to cash out. If you owe 150 and you're pulling 300 out, so now you're going to owe 450. The fact that you owed 150 and that rate was 3.25 has less weight and less bearing, in my opinion, because it's only on that 150 and you're pulling 300 out. The flip side of that is if you owe 550 and you've got that locked in at 2.75, and now you're telling me you're going to pull out 50 to pay off some credit card debt. No. Because now you're taking all that 550 that's locked in at 2.75 and taking it up to 5% or 5.25 just for that little 50 grand, right? That's a whole different story than owe 150, pull out 300, now owe 450. Hopefully that made some sense, right? So very scenario specific. Happy to go over that with anybody who wants to chat, because everyone's situation is different. 100% depends on what you're using the money for, what your ultimate goals are. Some people want to get all their debt paid off. Some people are accumulating real estate, accumulating debt. Those of us who look back are like, oh my gosh, why didn't I try to get myself in $2 million more of real estate debt at 3%? I'm one of those people. where if you look at the properties, appreciation, debt pay down, tax write-off, you're like, man, this debt was a powerful tool during these last 2 or 3 years while things were appreciating. Tenants were paying off the debt, and any money sitting in a bank account was just dying against inflation. So anyhow, long-winded explanation. Hopefully there was some value in that. Appreciate you stopping by. And, if it doesn't make sense, it doesn't make sense. Allie Lassie, thanks for joining. You're right. Inventory is super low, especially for multifamily due to the eviction moratorium. That's eventually going to end. And there's a ton of multifamily building going on, a ton. And I'm not sure if you're talking to like the smaller multifamily, the 2 to 4s, the 5 to 20s, or if you're talking about bigger stuff. But if you're, a mom and pop investor like me and so many others, you're probably talking about the smaller stuff, which I know there's some distressed sellers in that space. And there's also a lot of building going on. The last numbers I saw, I was surprised at like the new build numbers, and just thinking new build meant single family. Somebody corrected me and said, no, only 1.2 million of those are single family. All the rest of those are multi. I was like, okay, so there's a lot of multifamily building going on because we're just short inventory on all types of units, single families, multifamilies. We need more units for sale. We need more units for rent. We need more units, period, right? There's a lot of upward pressure due to lack of inventory on both home prices, as we all know, and rental prices. Good evening, Kevin. Thanks for joining. Appreciate you being here, man. Cheers to you in Florida. Carrie, thank you so much for this question. Amazing question. I've actually done quite a few of these in the last 3 months. I personally did one of these with a family member, so I know them front to back. Really, really cool thing for folks to know. If you are a child buying for a parent, you are able to get primary loan terms, meaning like if you bought a house for yourself and you put 5% down conventional and you got that 5.125 rate, and then you looked at what it would look like to do an investment property, 1, you've got to put 20% down. 2, the rate is closer to 6%. All the things that are the most attractive about a primary residence home loan, you can get that when you're buying for a parent, even if you're not going to live there. They don't have to be on the loan. You can basically apply for a loan on their behalf. All you have to show is proof that they can't afford the loan. Hey, I'm buying for mom. Look, she's on SSI and wouldn't be able to buy here if it was just her. 5% down conventional. It's as easy as that. I literally just closed, I think, 2 of these last month, and it was similar. Parent, is going to occupy the house. Child is the one on the loan, the one qualifying, and the parents are just going to live there. And it's basically priced like it would be if you were the one living there and buying it as your primary residence. You can already have a primary residence. That's no big deal. You just, again, have to show proof that they are unable to afford it on their own. If mom and dad are surgeons making $500,000 a year, right? You wouldn't be able to do that. That's the one caveat to it. Somewhere, let me see if I've got it here. Parent. I had a little flyer on it that I was sending to folks. Parent, child, purchasing for parent, owner OC. Purchasing for parent guideline. Let's see if I can pull this baby up. This might be hard to read. Let me see if I can zoom. There we go. Where's the zoom? Come on, baby. Zoom. Children wanting to provide housing for parents. If the parent is unable to work, or does not have sufficient income to qualify for a mortgage on his or her own, the child is considered the owner occupant, right? So owner occupant terms, you don't have to live there. You're considered the owner occupant, right? So that's straight from the guidelines, requirements for owner occupancy. Children buying for a parent. Great way to buy something with 5% down, put mom and dad in the same neighborhood as you. Gold, pure gold. Thanks for asking that, Carrie. Let me know if we can help. Go to greatmortgagebroker.com, fill out the form. Let us know you found me here. That's what you're looking to do. We're happy to help. Nolan Kitkoski, fellow broker. Thanks for joining, man. Appreciate you being here. As you may or may not know, huge advocate for the broker community. I don't like to rub it in. It's not one of those things where like I'm trying to flex on anybody. But when I left retail to go to the broker world, it was because I'm got this servant mentality, right? I want to serve people at the highest level. I want to give people the very best deal. As a broker, it's not just about like, hey, I've got, the ability to go to 5 or 6 different lenders. This one offers something I can do for a 550 FHA. This one's got the best VA. This one's got the best if I'm going 10% down conventional with a 780 score. This one's the best for doctors. This one's the best for, FHA 203K, whatever the case may be. It's that. And it's also the fact that, the broker model is just a different model, right? There's not a bunch of layers of management, corporate headquarters, and all these costs baked in to where there's some nice way to say this, oversized suits with oversized paychecks that add no value to the transaction. And if you are prime example of the veteran that came to me who was buying a $1 million home, 0.5% on interest rate is big on a $1 million home. And this lender that they went to told them, listen, we're at 5.125 for your scenario based on your credit score. Veteran doesn't know any better. All right, cool. I look at my rate sheet. I'm like, holy cow, I'm at less cost and 4.625. 0.5% on a $1 million loan is $5,000 a year. So that's $400 plus per month that you would save this veteran. And really the only difference, a loan's a loan, right, is that a retail lender with bigger margins is going to make 500 or 550 basis points on their government loans, on their FHA and VA. So long story short, yeah, should be working with a broker. I don't know. I probably, should play nice with my friends because I got a lot of friends in the retail space, but that's just my 2 cents. Joey Garesi, dude, you can tell me 100 times. I'm going to forget it every single time. It's just how my brain works. But yeah, thanks for all the support, man. I knew when I made that, I was going to shout you out because I had to do, somebody mentioned OKC and I got to do it for my boy. And you're right, man. Like that's a stat in those things. I think I'm going to do them every Saturday. If you haven't checked it out, guys, check out the video I did this Saturday and last Saturday where I checked out a couple markets, a couple stats on like what the demand is, how much they're building, how many folks are homeowners. Like some counties have 58% homeowners or 52% homeowners. And then of the people that are renting, how many of those can qualify? In a lot of these markets, it sucks because you'll have a renter pool of 400,000 people, but only 100,000 can qualify to buy. I guess the one thing to think about, Joey, there is that like, one, they're not all going to try to buy the median house. Some of them might buy a cheaper house. Some of them might have co-borrowers. And so there's like ways to view that differently than like, hey, if they were all if every renter was trying to buy the median priced home, how many of them could qualify for it? Only 25%. Yeah, that sucks. But if the median price is 400 and only 25% qualify, maybe 50% of them qualify for 300 or higher. I don't know. I'm an eternal optimist, right? So maybe that's just me, but yeah, those things I'm definitely going to continue. I think some people put some new places they want to see in the comments of those videos. I hadn't had a chance to look, but I'm going to go in and check out which markets and grab 3 or 4. And I think do that every Saturday until people tell me they're tired of it. Just because it's interesting, cool data to look at. So I'm going to do that all the Saturdays going forwards until I run out of markets or I run out of people watching this stuff. Mozilla 6. Thanks for joining. Appreciate you being here, man. Are jumbo loan rates that you're seeing still 0.5% lower than conventional? Do you expect it to stay that way the rest of the year? Also, generally speaking, all else being equal, how much are rates higher for 10% down versus 20% down? Is it worth putting more money down to get that lower rate? Okay, lots of stuff to answer here. Know that the jumbo market is a whole different animal. And in that jumbo market, there is so many different things to consider. $2 million loan, a lot different than $800,000 loan. 800 credit score, a lot different than 720. On conventional deals, like there's less buckets, right? Where the difference between 720 and 760, not that big of a deal. In jumbo, they're like every 20 points on your credit, 700, 720, 740, 760, 780. We're like, man, that guy's got a great rate at an 807 credit score. And somebody who's got a 717 got a terrible rate. A lot more credit sensitive on jumbo stuffs when it's talking about rates. Also, 20%, 30% down, those factors come into play. I don't think the spread's that big between conforming conventional and jumbo. Unless, and here's the unless you've got 1.2 million parked in a financial institution, they are apt to offer you a great rate on your jumbo. They want your jumbo loan. They want all your banking. They want all your business banking. They want all your credit cards. They want you to stay with them, keep all those money on deposits. They're willing to write that loan at a loss so that everything stays in-house, right? So that's where you'll really see the biggest spread between jumbo and conventional. On your question about 10% down versus 20% down, you shouldn't see a big difference on rate. Jumbo, yes, for sure, because the 10% has no mortgage insurance. But conventional stuff, 10% versus 20%, usually about the same rate. At 10%, you're going to have mortgage insurance. That's really how they hedge that extra risk, right? So you'll have the same rate, let's call it 5.125, 5.125 with 20% down, 5.125 with 10% down, but 10% down, you're paying $112 a month in mortgage insurance. And that's where the lender, makes up for that additional risk by you only being 10% skin in the game. Hopefully that was helpful. Joey, I'm telling you, dude, child buying for parent scenario is super interesting. It's super cool too. I swear not enough people know about it. Have I made a video about that yet? If I haven't, I am a complete idiot because it's gold, bro. Straight gold. I've made one. I had to have. If I didn't, I'm the worst mortgage YouTuber on planet Earth. But yeah, I agree. It's cool, man. It's super easy. I've done dozens of them and they're easy peasy. They're easy breezy, beautiful cover girl. How strong does the underwriting justification have to be for the parent loan? Currently doing this for my mom. Loan officer wants to get Social Security, 401k, and letter from employer stating retired. Most lenders aren't really that strict. I mean, on the last couple I did, letter of explanation and SSI statement. It should be pretty easy. I wonder if, maybe like they saw some employment. And so you have to get proof that like, hey, she is retired. Shouldn't be too bad. Depending on how far you are in that process, feel free to reach out to us. We'd be happy to help give you a second opinion. But if that loan officer's got it all dialed in, it's just a matter of getting some verifications and some letters, you're fine. V Quez, good to see you, brother. Thanks for being here live. There you go. Smash that like button. Last week we got 100 concurrent viewers at once. Today we're at 87. People are obviously, interested in the housing market, interested in mortgage. I appreciate everyone joining. Fire away all the questions you'd like. Next week we're gonna have a special guest, so we're gonna have probably less time for Q&A, more time to talk about what he's got going on. Let me see if I've got any sort of sneak peek at next week. Somewhere I might have a little trailer. Stand by. I want to see if I've got something from my buddy Sam Harris. I thought I did, but maybe not. But I want to give a little sneak peek into next week with Sam Harris. Yeah, you'll have to join. There'll be something posted for sure on my YouTube channel, on my social media. Association of Independent Real Estate Experts. That's the nonprofit that he runs, and basically to develop more independent African American real estate brokers, mortgage brokers, and other real estate professionals. Everyone has an opportunity to thrive and grow. Yeah, we'll share a lot more of his initiative, his story, and what he's got going on. It's really cool. Sam's a great dude, so look forward to that conversation next week. Thanks, VQuez, for showing up and reminding folks to smash the like button. Papa, been on the sidelines for years, thought prices were too high. Oh shit. Then pandemic hit and froze me out, waiting for inventory to go up. Strong credit and job history. My cash position just needs some good vibes. Well, good vibes to your cash position. Hopefully, you're able to put things together, because it's not like a timing the market thing. And this is where I think a lot of people get it wrong. I spoke about it a little bit earlier. The best time to buy a house is when you are in a good financial position to do so. Period. The end. Not when interest rates are the lowest or home prices are the lowest, or you think it's a great time in the market. You buy when you are stable when it comes to job, when you're stable when it comes to credit, when you're stable when it comes to reserves and enough for a down payment. You do all that stuff and analyze it from okay, I can afford $1,850 a month. Let's do this, right? Like, that's the conversation. The conversation is not like, what is this house going to do in the next 5 years from an appreciation standpoint? Or what is this house going to be worth next month, right? Because no doubt your rent is going to increase wherever the heck you're staying at. And you just got to look at it like from a perspective, like, what fits into my budget? $1,850 a month. Can I find something that I qualify for where my mortgage is going to be $1,850 a month? And if so, and you believe in home ownership and you believe in all the benefits of home ownership and all the millionaires that own real estate, then that's the driving factor, right? So anyhow, rant over. Matt, can you run this purchase scenario, please? 650 loan amount, 95688 zip, 800 credit score. What rate for 800? All right, Johnny, we need a couple more things. What's the purchase price? 650 loan amount. But what is that? 10% down, 20% down, 50% down? I'll run this bad boy for you for sure. And why you want an $8,000 closing cost credit? Johnny Co. $95688. I'm dialing this one in. I just need to know the sales price. 900. I'm doing 650 loan. Scott Wang, thanks for joining. Home equity loan. Generally speaking, small community bank or credit union is going to have the best terms on a home equity line of credit. If you're in California, hit me up. I've got a guy I refer to who's great. He'll run your scenario, let you know if it's a good idea, let you know the terms. Just shoot me an email, matt@mtmg.com. Hey, I'm looking for a home equity line of credit. Please refer your guy. I could even put it here. I don't think George would mind, but shoot me a message. I'll be happy to help. This is a good question, Joey, because what were we just looking at? I literally put it up on the screen and I already forgot. Parent, buying for a parent. Does not have sufficient income to qualify for a mortgage on his or her own. Hit us up, Joey. This might. Yeah, if she doesn't have enough income on her own, I feel like that qualifies, right? Dan and Bev Perkins. Only residential, guys. Thanks for asking. But yeah, mixed use, commercial, whole different ball game. I've got a great commercial guy in California who I could refer to. So reach out to me if you want Manny's contact info. As far as anything 5 units or above, mixed use, commercial, whatever the heck it is, not my wheelhouse. Hey, Carrie, for sure, I'm gonna do a video on buying for a parent. Parent loan, Matt, the mortgage guy. God, I feel like I've done one. I'm gonna try to search for it right now. Did I really not do one? All right. If I'm good, I'm gonna have this done and out by Thursday at 2 p.m. This is a good one. All right, Carrie. I'm going to shoot to have this filmed sometime in the next 24 hours so we can get it edited and out to the YouTube universe by Thursday at 2 p.m. All right. Challenge set by myself. Challenge accepted by myself. Man, I don't want to mispronounce it. I'm like, Antares? Whatever it is, thanks for joining. Appreciate you being here. What are the programs available for first-time home buyers? As a first-time home buyer, there's a lot of state-specific programs where it will depend on what state you're in. If you're talking about like down payment assistance or something like that, widespread programs, there's a lot of different stuff. Like I just saw something yesterday that was a fairly small bucket, right? Where you've got to fit under a certain area median income, but there might be some credits available to you. You're able to do 3% down on conventional versus 5%. Probably too many to list here, but here's what I will tell you as a general rule of thumb. Like there's no true free money that says you're a first-time home buyer. Here's a bag of money. Thanks for being a first-time home buyer. Truth be told, there's just too much demand in the housing market to do something like that because it would just create more demand and pour more fuel on the fire. With all that being like said and understood, you just want to go out there and search for the best program for you based on your scenario. You know, if a lot of people come to me and say, I'm a first-time home buyer, I've got 20% down, but what kind of programs are there for down payment assistance? Well, you put 20% down, you get the best rate in the market, and you've got your mortgage that's this. Or you try to get into some down payment assistance program where, one, you may not qualify because you have too much income or something, but two, you're going to take a rate that's way above market. You're going to pay a bunch of fees, and essentially everything gets baked into that down payment assistance program is, hey, we're giving you free money or a loan, and you're paying us back with interest and fees, right? Like some down payment assistance programs are so bad, I equate them to some of those payday loans, right? Where you go borrow $400 and you pay them back $2,200 over the next 6 months with interest and fees and all that. Not the best way to do things, right? So not to discourage you or not to say that there's not good programs out there, but just go get yourself pre-approved and let a good home loan advisor advise you on, hey, here's what's available to you. Here's down payment assistance. It might not make sense for you, and here's why. You'd only qualify for up to $385. You can't find anything at that rate, and look at how big your payment is. Or if you put 5% down, here's what it looks like. You'd be able to qualify up to $450. Sure, it'd be a little bit more out of pocket, but your payment is $400 less per month because it's not the higher rate and it's not all those extra fees. Whatever the case may be, like those are the kind of conversations you have. That's the type of information you want to seek out. Okay. How long are pre-approvals good for, and do they expire? Go to Matt the Mortgage Guy on YouTube, type in, do pre-approvals expire, importance of a pre-approval, all kinds of things around pre-approval. I've made a ton of videos about these. Pre-approvals are as good as long as the information remains the same. Credit profile, no new debt, job, same pay, interest rate. And that's the biggest thing about today's market is a pre-approval from January might have lasted 3 months in a different world, but in 2022 world, rates are exorbitantly higher than they were in January. Sorry to say it out loud, they just are. And so that pre-approval is no good because things have changed. So if my best advice to buyers in the market in 2022, get yourself pre-approved. A good loan officer is going to give you options. Here's what it looks like to buy for $500 with 5% down and 10% down. They're probably going to give you a little bit of cushion, right? You're good up to $550,000. That really means for me and my team, you're probably good to $580, but we want to give it a little bit of cushion. One, rates might creep up. Two, we write you a pre-approval for $550. Your realtor is going to write an offer at $565. That's just how they get down. So if you got yourself pre-approved and it's been over 30 days, whether you're working with us or whoever you're working with, check in. Hey, just wanted to make sure everything's still good with my pre-approval. If you're working with us and it's been 45 or 60 days, we're going to say, get us the most updated docs from your job. Rerun scenarios based on the new interest rate. Do whatever we can to freshen it up and say, yep, you're good. Continue to house hunt. Let us know what else you need. That's a long-winded answer, but it's really the honest one. Inessa, thanks for joining. I appreciate you. The thing that's driving rates so high is that rates were naturally not as low as we saw, right? The Fed, who controls monetary policy, I'm trying to keep this as simple as possible, was basically buying up mortgage-backed securities and making rates really low. They did that over the last few years. And really, rates should have never been at 2.6%, but they were because of all the buying that the Fed was doing. And as the Fed stopped buying, and the Fed's even, probably going to do some selling, interest rates will go back up to normal levels. Right now, we're in the 5s. All the things that they've talked about doing is the opposite of all the things that made rates go down, buying up mortgage-backed securities and whatnot. And so rates will naturally continue to rise. It doesn't necessarily correlate with the Fed funds rate, but the Fed funds rate, like the rate at which institutions lend money to each other, if it's at 0.25 and in May they raise it to 0.75, the next meeting they raise it to 1.25 and that thing goes up to 3.5, mortgage rates tend to follow, right? So it's not a direct correlation. And I don't know if I should have even gone down that path, but rates will continue to rise as long as we're doing the stuff that we're doing, we being the Fed, to increase interest rates, which they're trying to do. They literally came out and said, we're going to raise interest rates to quell demand so we can kill inflation. Inflation's at 8%. It's not good for anybody, right? As they do that and they kill inflation and we go into an economic recession, one of the ways to pull us out of that recession is going to be the stuff they did before to pull interest rates down. And so if you want to know when are they going to go down, whenever the Fed reverses course and starts to buy mortgage-backed securities or, decrease the Fed funds rate in the future, 6 months, 9 months, 12 months, we don't know. It'll depend on a bunch of different economic factors, but I don't think you should expect rates to go down anytime soon. For the foreseeable future, next 3 to 6 months, rates are only going up. That's my opinion. All right, 1-1 purchase. That was an important detail, bro. Okay, let me do this little price check. You need 8. You need 8,000 in credit, Johnny. All right, your world. All right. Solano County. Oh, maybe. Are they 647, 200 there? All right, I'm going for a loan amount of 647, 200. So it'll be down payment of 452, 800. So we don't want it to be jumbo. We want it to be conventional. And you want 8,000 in credit? To get you 8,000 in credit, we got to go to like 5.25. 5.25. I'll give you 8,000 in credit. All right. You let me know if you're ready to roll. Let's do it. 5.25. 8,000 in lender credit on that scenario. Rob Toyer. We sure are. Greatmortgagebroker.com. Fill out the form. I got a great loan officer in Arizona. Quick form. We'll contact you within 24 hours. My buddy Peter on the team will connect you with our Arizona guy. Get you rolling. All right, Drew A. Here's a great question, and hopefully we can help some other people with the answer. My father wants to give me money for an investment property, gift me money for an investment property, no strings attached. If I'm pre-approved, how do I let my loan officer know where the money came from? Is there any negative impact? You cannot use gift funds on investment property. They're not allowed. So if you're buying a home for your primary residence, you can get a gift of any amount. 10,000, 20,000, 300,000. I've seen gifts of $1 million. If you're buying an investment property, it's just the guideline. You cannot have any gift funds. They've all got to be your funds. So that's the answer. If you were to have your father give you $100,000, no strings attached, like you said, and it went into your bank account and it sat there it's got deposited today. You go and buy a house in July, and in July you're showing June and May bank statements. That money is already in your account and seasoned. So it's not necessarily going to, be shown as a gift because it's been sitting in your account and it's seasoned. But if you're buying a house now, you cannot use gift funds for the purchase of an investment property. Sadi. Thoughts on rent versus own in the Northeast? Looking for almost 2 years now that we are set. Rates plus prices equals unaffordability issue. Unable to keep under 30%. We have outgrown our 2-bedroom 6P and rents are equal to mortgage. Well, if rents are equal to mortgage, 3-bedroom apartments are 2,500 and above, then if you're able to buy, I think it becomes like I'd probably buy. The thing about rents is that you don't have any control. Mortgage on a 30-year fixed rate note remains the same year after year after year after year. People don't realize how great of a deal long-term mortgage debt is. Like somebody who got a mortgage 10 years ago and is paying the same $1,232 a month for a house that's now worth $700,000. People in that neighborhood are absolutely disgusted that they're paying $2,700 a month in rent and that person pays $1,232, right? Because the payment just stays the same. 30-year fixed rate. Today, it might not feel that great if you go get a mortgage and it's $2,600, and that's a stretch, but the $2,500 rent is a stretch as well. But guess what? You wake up in 10 years, I promise you feel great. You wake up in 20 years, I promise you feel really good because you've got a $2,600 mortgage and things are now renting for $4,000. That just happens with inflation, right? Rents go up. That's why real estate investors love having fixed rate debt, and they love having assets like real estate that appreciate in value. The debt is fixed, and then rents just continue to go up, right? So anyhow, I think if you're able to buy, you buy, right? That's the only fix, because I think rents and prices of real estate are both going up over the short term and the long term. All right, Mozilla 6, thanks for joining. Appreciate you. Ryan Longcock, what's up? Thank you for coming by. Appreciate you being here. Hope you're enjoying the YouTube stuff. Mr. Greg Dickerson, man, you are number one in his fan club. I'm a close second though, hopefully. He probably was better than anybody else. I, for one, didn't predict him as fast as they went up, but all right, I gotta roll. I got some work to do. Holy 410. I appreciate everyone who joined. I really do. Come by next week. We're going to have a great one. Like I said, we're going to have Mr. Sam Harris on here discussing AIRE. I think that's how you say it. AIREE. His group that he's launched, all the great stuff he's doing for generational wealth in the communities he serves. So join us next week, 3 p.m. Pacific Standard Time. I appreciate each and every one of you. As always, until next time, we gonna see.